Today we're going to be talking about Canada is officially in a recession and what it means for your mortgage rate.
New data from Statistics Canada shows the country is in a technical recession.
A technical recession.
Technical recession.
Now, just last week on May 29th, Statistics Canada announced that the GDP has declined by 0.1% in the first quarter of 2026. Now, this is hot on the heels of a 1% GDP decline in Q4 of 2025. So by technical definition, 2 straight quarters of negative GDP growth would mean we are in a technical recession. Now, we've actually seen 3, so we've been in a technical recession for a little bit longer. In 2025, we also saw the GDP decline by 1%. So generally, when we're in a recession, many ask, okay, we're in a recession. Now, wouldn't the Bank of Canada need to start cutting their rate to stimulate growth? And in many cases, yes. However, this situation is a little bit different because we also have the inflation concern. And this is something that they are watching closely. It's something they take seriously. Obviously, inflation affects the cost of everything for everybody. And the Bank of Canada, one of their key roles is to keep that in check, keep inflation in check. So if they were to go and start cutting their rate, well, that's going to drive inflation and fuel that problem. So we've got the economic problem on one side, and then we've got the inflation problem on the other. They need to find the right balance with their next move. Now, their next move still will be up. It's almost certain it'll be up. This is what all economists are expecting. So a cut is not going to be in the cards. It's not expected at all. But what could happen and what likely will happen is they will not hike their rate quite as much as what was originally anticipated. Now, we're still calling for a hike later this year, likely by 0.25%, and forecasts are calling for more hikes in 2027. Now, as new information comes out, these forecasts will change. They're always changing. It really depends on what's happening. And the big question mark right now is what's going to happen with this war in Iran? What's the outcome of that going to be? Now we've got more tariff talk being thrown around by Trump. So these are all things that do not help our economy at all. And they're all things that are big question marks and so much uncertainty surrounding them. That is what the Bank of Canada has to deal with here right now. Because usually, yes, a recession means they need to stimulate growth. But with this war in Iran and the Strait of Hormuz being closed and the gas prices substantially higher than where they were before the war started, this is all driving inflation. Now, eventually this war will end. And when it ends, we would expect the stock market to rally. We'd expect bond yields to drop, which would then bring fixed mortgage rates down with them. But the question is, when is this going to happen? Now, one thing that we also need to look at is whenever the Bank of Canada does make a move, whether it be a cut, whether it be a hike to their prime rate, it can take 12 to 24 months on average for them to realize what the economic effects were of that move. Now, if we fast forward to 12, 24 months, let's hope that this war in Iran is over by then. And that's what they're thinking. They're thinking that it likely won't last that long. I mean, we really don't know. Knock on wood, let's hope it ends much sooner than that. But they don't want to go and make a move based on anything right now, because once that war does end, that's when it kind of changes the game. So they don't want to make a move right now if the effects are not going to be seen for a minimum of 12 months. Now let's talk about fixed rates for a moment. Now, fixed rates are heavily influenced by bond yields, which you hear me say all the time. Now, bond yields, fortunately, are down a fair bit off their peak. We did see a large spike to the yields in May. That brought them up to their highest point that they'd been in 2 years, which led to several lenders increasing their fixed rate, several of the lowest rate mortgage lenders increasing their rate. Well, now bond yields have fallen back down to around the same level as where they were a couple of months ago. Now, we haven't seen any rate cuts as a result of this drop. It's possible that we may see a few. It's to the point where it's possible it could happen, but we would really need to see the bond yields continue to fall further before we can expect any notable drops to fixed mortgage rates. And it's very possible that that could happen. Right now they are down, but with all the volatility out there right now, whatever we're forecasting, whatever we're talking about, or whatever the direction is of the yields, that can change on a dime. It could change by the time you watch this video. It could change by the end of the day. It could change tomorrow. It could change next week. We really don't know, but eventually it will change. It all depends on what is happening. And sometimes it just takes a single tweet. Do they still call them tweets? From Trump that can drive it in one way or another. Now, right now, the lowest 3-year fixed for an insured purchase is sitting at 3.94%. That is pretty much the only rate available right now, starting with a 3. Mostly everything else is in the low 4%. Now, there's not a big range here on what's available for 3-year rates right now. Generally 3.94 for insured. If it's uninsured, regardless of category, it's as low as 4.04. We're generally going to be within that range. 5-year fixed rates start at 4.09 for an insured mortgage and go up to about 4.19 to 4.24, like in around there for uninsured mortgages. So that's the range right now on fixed rates. Variable rates have a larger spread. On an insured variable rate, there is as low as prime minus 1%, which is 3.45%. For uninsured, it is prime minus 0.7, which is 3.75. So a little bit of a larger range there, depending on your situation and what rate category you fall into. There's also some uninsured situations where you could be as low as 0.1%. In those cases, you need to have 35% equity in the property. There's other factors involved that come into play when determining the lowest rate you'll be eligible for. And we are very committed to ensuring you get that. That's why we ask you a lot of questions before we can determine what the lowest rate is that you're eligible for. Now, the next Bank of Canada announcement is set for next week, June 10th. And don't expect any change here. They are not going to make a move one way or another. We will get an update from them on, what they're expecting, what the economic situation is, and even maybe what we can expect to happen. Possibly, we'll see. There is just so much uncertainty out there. The trade wars are continuing. We don't know what Trump's going to do next. We don't know what's going to happen with this war in Iran. So a lot can happen. Now, hopefully we'll see some drops to fixed rates, but that is not guaranteed. When we do this video again next week, we could be talking about rates rising again, or we could be talking about rates dropping. Let's hope it's the latter. I love talking about lower mortgage rates, not rates rising. Our job is to save you guys as much money as we possibly can, and we need rates to be as low as possible for that to happen. So we're always monitoring the market. We're always sourcing out lenders with lower rates so we can bring those to our client. Now, the only way to protect yourself and guarantee you're going to get the lowest rate is to get something locked in as soon as possible. Even if rates are dropping, that's fine. We will lower your rate for you. We'll get it dropped for you if we already have an approval for you, even if you've already signed. If the rates drop, we will still get them lowered for you. We do that all the time for our clients wherever possible. We love coming to them and saying, hey, guess what? We just got your rate lowered. So that's something we take very seriously here. Now, if you get something locked in right now, and if rates rise, well, then you are protected. Now, if rates drop, then again, we can get them lowered for you. Now, we might take an application from you and might say, well, let's watch the market for you so we can strategically submit it for approval at the right time. Sometimes we will do that. Other times we'll say, let's submit this and get it locked in. But either way, we need to get everything in place so we can be ready to pull the trigger to ensure we're getting you in at the absolute lowest rate possible. I write a blog every Wednesday. You can check that out at easy123mortgage.ca/blog. It's on the same topic, so you can check that out. If anybody has a mortgage coming up for renewal within 120 days or a purchase closing within 120 days, then reach out to us to find out what the lowest rate is that you'll be eligible for. info@pmtmortgage.ca. If you have any questions, email us that. You can post comments here, or you can call us the old-fashioned way, 647-368-5009. We would love to hear from you, and we will advise you as if you are our own family. We are always going to do what's in your best interest. So even if it's contrary to our own, we do that all the time. We just want to make sure that you're well taken care of and we're putting you in the best possible position.